Sushovan, great to have you on the show today. Thank you so much for your time. Let me start off really with the assumptions because they're hinting towards a narrow sequential constant currency growth for large caps across the board. What are the major triggers that you find worth noting down this quarter for IT?
So, Aisha, uh, basically, if you look at whatever is happening in the large caps, we see value basically coming in the large caps. If you look at the free cash flow yields of most of the large cap IT companies, it's almost between 5 to 6%, right? And despite whatever regulatory headwinds have happened, if you look at the H1B visa, the fact that discretionary demand has still not come back, and with Trump tariffs also having an impact on the IT sector as such, despite that, the sector has remained resilient. While from an EPS CAGR perspective, overall for the sector, we believe, at least for the large caps, we believe that this will be around 7% from FY26 to 28, despite all of these regulatory headwinds, which we believe is something that shows the resilience of the sector as such. So we are actually positive on the large caps. Our top picks would be Infosys, LTIMindtree, and HCL Tech within the large cap space. While in the mid caps, we believe that we just have to look at the valuations and the growth corresponding to those valuations. For us, we'll be a little more selective as far as the mid cap IT space is concerned. Yeah, that's the way I would look at it.
But tell me, what cost levers do you think remain within the IT large cap? And let's talk about the large cap pool first. To protect their margins, I mean, could it be automation, offshoring, subcontracting, anything else that you foresee?
So, if you see what has happened with TCS, right, the fact that they've announced those layoffs for the middle and the slightly senior level employees, although it's unfortunate, what we are seeing is that this is very similar to what Accenture had done, right? Accenture, even in their last earnings call, they have basically announced almost 11,000 layoffs where they have basically budgeted in $865 million specifically for that. I think TCS is also doing very similar things. It is basically pyramid rationalization so as to reduce the costs and potentially improve the margins. And uh, uh, what we are seeing basically is that if you look at products, AI related products that most of the companies are basically invested into, because that is going to help in reducing the software development lifecycle. Most of the large caps, most of the mid cap IT companies, let's say Persistent, Coforge, LTIM, Infosys, all of them already have their products in place, right? So that is anyways taken into consideration. There's a productivity related benefits which are being passed on to the customers. But what it is going to help is basically increase the share of wallet for the more aggressive or the more uh, adaptive players in this space. So that's something that is going to be beneficial for Indian IT in the long run, although there'll be short-term headwinds, basically because of the H-1B visa, that companies may resort to things like offshoring, which will possibly reduce your billing rate for some time. But what it will possibly help is in improving the margins as such. And with the share of wallet increasing, we'll possibly see the absolute EBITDA or the absolute cash flows increasing, which we believe this will be something like a hockey stick phenomenon, where for some time there will be some amount of revenue deflation, but with increase in share of wallet, we'll see an improvement in margins and profitability and the absolute EBITDA also increasing. That's the way I would look at it, Asha.
Right. Sushovan, this is Harsh also joining in the conversation. Talk to us about deals. What is your outlook with regard to wins coming in? You are likely to see a 50 basis point rate cut between maybe now and March. At least that's what the consensus is building in the US. What's the sense like, and how do you see commentary play out as a result of that consensus building up?
So what we see, Harsh, is like there are these players which are more adaptive to AI. They are the ones which are going to benefit. Like if you see what Infi mentioned the last con call, they said very clearly that for most of the larger banks, they are one of the preferred AI partners. And as a result of that, the ones which are more adaptive to AI are the ones which will win the large deals. Look at what's happening with LTIMindtree, right? They had won the large deal which was there in Q4 with the US food manufacturing listed player. Now they have won another deal which they announced yesterday, which is almost an equally large deal. which they've won. So basically, my only limited submission here is the ones which are more adaptive to AI, which have been able to infuse AI into their operations, have invested in the products. Like Infi has their Topaz, they also have their cloud platform, which is basically Cobalt. And if you look at LTIMindtree, they have invested in Blueverse. All of these things, the ones which are adaptive, they are the ones which will end up doing well in this AI play as such.
Okay. And how do you view valuations, Shishovan? I'm trying to understand that some of the valuations at the mid-cap end are, of course, elevated. The larger cap are sitting at slightly lower than 5-year averages, I would reckon. Do you believe that given the kind of growth, single-digit sort of growth that most analysts are penciling in, how do valuations stack up, at least for the large cap end and for the mid-cap?
So for the large cap space, Harsh, basically for us, the large cap space, it's almost at 20 times FY27, which we look at large caps, it's basically their 10-year average is almost close to 20.5 times, right? FY27. So we believe large caps are basically from a valuation perspective, given their free cash flow yields, and also with companies like Infosys, some other companies also we believe will end up doing buybacks. That will basically act like a floor from a valuation standpoint, and they are the ones which we will be more comfortable with. Within the mid caps, at least within our coverage universe, the FY27 price to earnings multiple is almost 29 times. And what we like within this space are BFSI plays, someone like an Emphasis. From a valuation perspective, companies like Mastech, which are trading at almost 15 times FY27. And also, they give you that hedge against the US exposure, given they have got a significant UK exposure, right? And they've got a recurring revenue stream from the government, the NHS, as well as the Bank of England, all of these government entities. So for us, that gives us a little more comfort. We also like some BPO plays within the mid cap, like First Source, where we believe that the execution is something that has been really good under the new leadership, and that is something which we are quite comfortable with. And BPOs as such, also what we are seeing is the growth for them is comparatively better than the large of the mid caps as of now. I hope that clarifies as such, Harsh.
It does. But Sushovan, thank you so much for